Good Friday morning, Market Chameleons, and everyone join us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with this man, Dimitri Pargamonic. How you doing, D?
Good morning, Will. How are you?
Great. You want to start with the disclaimer?
Yep. So, good morning, everyone. Before we get started, keep in mind Will and I and Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need advice, call your registered investment advisor, call your broker. That's what they're there for. There's the
Excellent.
disclaimer. And I'm going to share my screen. While I'm doing that, if you're joining us for the first time, Will and I, we do these shows in the morning to try to help answer questions you may have about the Market Chameleon tools, the data, the analytics. If you have a question, type it into that live chat on YouTube. Will's watching it. He'll read it back to me. And to give you guys a couple minutes to enter in those questions, we're going to take a look at the pre-market report, see if we could get insights, what's going on in the pre-market hours, and then we're going to move on to the questions. Okay.
Perfect.
So pre-market report, these are stocks trading in the pre-market hours. And up top here, we have a calendar view of the pre-market activity. And that does allow you to go back to a historical date, see what happened in the pre-market hours on that date. Today, we're on December 29th. So here's a summary from a high level what's going on. We got 432 stocks trading higher in the pre-market, 258 stocks trading lower. As far as volume goes, we have 147 million shares trading on up volume versus 177 million shares trading on down volume. And if we convert that volume to dollar value, we have $1.2 billion worth of stock trading higher versus $490 million worth of stock trading lower. So from that perspective, looks like the trading in a pre-market hours so far is leaning with a bullish sentiment. Now, let's take a look at it from a couple more perspectives. Then we'll move on to the questions. Down here, we have a list or a couple lists of symbols or stocks trading in the pre-market hours. Okay, we have a list of our most active stocks, our biggest percentage gainers, biggest percentage decliners. 33 stocks made our biggest percentage gainers list and 15 on our biggest decliners list. Now, down on these lists, we do set thresholds that the stocks have to meet for liquidity, price, volume in a pre-market to make this list, because things in the pre-market are very illiquid. However, you'll see that there are stocks in there that are low cap stocks, ETFs, leverage products. Any security listed on a major US exchange, if it's trading in pre-market hours and meets our thresholds, it could make this list. To narrow it down to a smaller group of stocks, we could use the filters above. If you have a watch list, or you could filter by your watch list using this filter, we're going to use this one in ETF. When you click on it, when you click on it, you get a drop-down menu with different ETFs to select from. We're going to pick this one, SPY. That's the S&P 500 ETF. And when you do that, the list below gets filtered by stocks that are holdings in the SPY. So now we see that none of them made our percentage gainers list. One made our percentage decliners list, only Uber. So that's pretty much even or balanced in the pre-market. And keep in mind, the biggest percentage gainers list, biggest percentage decliners means that they have to meet certain thresholds and break certain price swings to make that list out of the ordinary. So we gave it a couple minutes. Well, if we have a question, I'll take it now.
Nothing's popped up, D.
Okay. So let me default to SPY. while we're waiting. And let's go to the options chain. So what we have been doing for the last, couple days by default is using the option profit calculator to construct different types of strategies. And then once we construct, different legs, we tried 2 legs, I think we did 3, 4, and so on, the time spreads. And the idea there is to visualize the profits and losses of that strategy at expiration. We manipulated it, but another important thing is to try to construct a strategy and get a sense of, where are the markets versus a, perceived fair value or benchmark, and how far they deviated. So let's do that today while we're waiting for questions. And I'll use SPY, and, what some of the most popular strategies we could see here are the 0 DTEs, the options that expire on the same day, right? So these were yesterday's, we're not open yet. The market's not open, we're in a pre-market, but this is December 28th. This is yesterday's options chain. So let's move back, and down here you have the ability to go back to a certain time in the day and look at the markets or the market snapshot at that particular time. So let's go yesterday till 3 p.m. So 1 hour. So we have 1 hour left in the trading day. Okay, so I'm going to hit this 3 p.m. down here. And what will happen is that now we're seeing a snapshot of the options chain at 3 p.m. Right? So the benefit is we could use that to study the markets and look at what might be interesting. What would have I done here, and how did it play out? Right? That's part of how you prepare, right? Go back and see, like, okay, maybe I have a strategy in mind that's based on the last hour of trade. Okay, so I could go back to yesterday's, the day before, whatever. You have this ability to go back and see how your strategy would have played out, so you could be prepared right ahead of time. That's how you prepare, do your research, and so forth. So let's just take a look at this one at 3 p.m. And to make it life easier, we'll say, okay, we have 1 hour to go, and in the next hour I want to play the stocks movement. How much can it move away from the strike price? Because the most what do we know is that usually those 0 DTEs, the trading will usually center around the strike price, the at the money strike price. So as the stock moves, those strikes that are closer will get busier in most of the trading. So let's just see, how these at the monies yesterday lined up, and we see that. So the stock at this 3 o'clock was at $477.20. So the 477 strike is the closest strike to the stock price, 20 cents away. So to see, as far as movement away, let's look at the straddle, right? And then we're going to evaluate the market prices of the straddle. How does that straddle price, how does that straddle price compare to like what we perceive, the stock could potentially move based on historically how it moves, right? Because we need some kind of benchmark to get a sense of, is this really is this really low? I mean, I could, eyeball in it. I don't know. How do, all I see is just prices. So I need some kind of historical perspective, some kind of data and benchmarks to give me some guidance, where the market's at. Is the market signaling something? Is it a little bit undervalued, overvalued? So that's what we're going to try to do now. So let's take the 477 strike, and I'll just set up selling a straddle, right? So when you sell a straddle, you're doing a call. So here I clicked on the bid on the call. So then it said selling December 28th, 477 call for 47 cents. That's the market right here. And then I'm going to turn around and do the put, 27 cents. I'm going to click on that. So what do I have here? Selling the December 28th. So keep in mind, this would be yesterday, right? At 3 p.m. So that this would have an hour to go till the close. Well, actually at 4:15, right? But let's just say an hour to go. So here I have the straddle set up, selling the December 477 call, and then selling the December 20th 477 put. So if I calculate that initially, what do I get? Is you see that you sell this for 74-cent credit. This is the market, and this is what it looks like, right? Because you're selling a straddle, so you want that stock to sit right at the strike price, and you want them both these options to expire worthless. That's your best case scenario. And then the question is, well, am I getting enough premium to take on this risk? So even though if I feel very good about it and that the market's not going to move, but what if it moves its average, but how much does it move on average? Like, am I, getting enough of a premium? If I'm underselling it, by how much am I underselling it? Because how confident am I, that it'll sit here? Because if it does its usual move, right, then how am I looking at that point? So then what does that mean? Well, we're going to, our theoretical value, we need to create to compare to this market, right? We need a benchmark to compare to these market prices. So I'm going to go here, distribution. So what we want is a theoretical value, right? But we need it not from 355. What we need it is from 3 o'clock, starting at 3, right? From 3 to 4 to the end of the day. So I'm going to change this to 3 p.m. Okay. So now I'm going to look at the movements of the stock from 3 p.m. to the close, and it's going to generate a theoretical value for these options. In addition, I could narrow down my data even further. What about the day of the week? Well, yesterday was Thursday. So let's look at how the stock moved the last hour of trading on Thursday, the last day of the week, okay? Because maybe that could be different than on a Monday or a Tuesday or Wednesday. So we're going to narrow it down even more. So you could see that, if I use all the data, I'm going to get a different output than if I just go Thursday. Okay, but let's just go Thursday. So now in the background, it's using that filter, right? Show me only Thursday, the stock movement from 3 p.m. to 4 p.m. in SPY. So let's load that in there. Reload. Okay, so there we go. So based on SPY's historical stock movements from 3 p.m. to 4 p.m., what is the average end value of these options? That's what this is looking at. What would the average end value be? So we see it's 76 cents. which is really right in line with the market. So really the markets were basically pricing it right at the historical benchmark of the historical stock movements. So it's fair. And look, maybe I still feel strongly that, well, today is going to be different. There's people out. There are people going on vacations. We have the holidays coming in. It's going to be slower than usual. But at least I know that, okay, the market is really at its historical average. So, in long term, that would be, a theoretical break even. So I might still be willing to take that shot. But now I know, where the market prices are versus a perceived or theoretical value that is data driven by this model, right? That's the model we use. We could change it. Let's say, well, what if we used every day of the week? How would this change if we changed our assumptions? So let's just use let's say it doesn't matter. The day of the week does not matter. The last hour is the last hour, right? So Monday, Tuesday, Wednesday doesn't matter. So let's just see if that plays. And we have the ability to change it, right? Like to compare both. That doesn't mean one is more right than the other, right? All we're doing is just changing the inputs into our model to see how they differ. So let's do that. Here, if we used all the days, Monday, Tuesday, Wednesday, Thursday, Friday, then we see that, yes, it's a little bit lower, right? Then one's 75 cents, one's 69 cents. So what it's saying is that, there are days of the week that it's less volatile in history than just Thursdays. Okay. Now, some people ask, well, which one do you use? Keep in mind, there is no right answer to that, because it's giving you an answer to two different questions, right? That doesn't mean one is better than the other. What it's doing is saying, now, I'm studying the data, but I could change the data around. I could change the, some of the assumptions, because, there is no right. There is no right answer to, if I use this data set, it will always be more correct. It doesn't work that way. It's just, now we have an answer to two different questions, right? We have an answer to, well, historically, how did the last hour, based on the last hour, what would be the end value? And historically, what if we use the last hour just for Thursday? How did that look? Right? Now we have two different data points to consider, and they're a little bit different, right? But that plays into your decision making. Okay. Doesn't mean one is more right than the other. It means that those are the two different, though they're different. That's what the data tells us, right? They're two different answers to two different questions. So we have, then can we analyze it even further, right? Like, okay, it's 3, yeah, it was 3 o'clock. What have we done? Well, let's look at what the options. Oops, hold on a second. Yeah. So now I have these at 3 o'clock. So what do the options usually price the move? So that was from the perspective, what we did was the actual stock move, right? We don't care what the options were pricing historically. We just said, well, how much did the stock move, and what would the options at the end value be, right? That's what we looked at. Irrelevant where the options could have been priced at $1 million. We don't care. What did the stock do? Because at the end, the options are going to expire either in the money or out of the money. They're going to be worthless, or they're going to be in. Now let's take a look at where the options historically were priced at 3 p.m. Right? So here's a 3 p.m. snapshot. And what we do is go back and say, well, what is a similar option? What was the premium for this strategy? Okay. And then we convert it to a dollar price, and based on today. So yesterday, if the credit was 74 cents, you could see on average the premium of the options would have suggested that this straddle would have been $1.07. So it's doing all the conversion for us, right? Going back from percentages to dollar value. So you could see that that even though it does look like it was more in line with the historical average moves, based on where the premiums are, usually the premiums are priced a little bit higher. So it is priced below where that straddle was priced. And then we could kind of go back in time it, so this is the average of all the observations, but we could just see the trends going back, you could see like that it could give out. You could see the range here. So there are big ranges in this. Then again, we could keep narrowing it down. Say, well, why don't you just show me Thursdays? Thursdays alone. Rerun that. So $1.10, almost very similar, right? So now we got a couple of different perspectives. Like, okay, the options, usually they're priced higher. They are priced lower than the historical, average benchmark. But they're priced more in line with what the stock has actually done, or the stock has actually moved. So let's go back up here. Remember, we're just looking at history. So we're like, okay. So now let's take a look at what this straddle actually looked like at 4. Now, well, how did it play out? So I am going to close this. And we could see here from 3 o'clock, we see that the stock really did stay around the 477 because these are snapshots, right? But 330, 335, 340, 340. So there you go. So we could see where the stock ended up, 359, 476.52. So let's click on that. And this is right, like, let's say right up near the end of the day with 30 seconds to go. And here we go. So the 477, so it's already below, right? So this option 477 is already out of the money. It had it. Keep in mind, it does go to 415. So this goes to 415, but this is 3 cents, around 3 cents. And this here is, well, we could see here 48 cents in the money. So it didn't, right? It moved. It actually did move from 477 from 477.20, right? It moved below down to 468.52. So it did kind of, it made some move, but it would have been 48 cents in the money. So in that perspective, if you sold it, it would have been a small winner, right? Because if you could buy back, we're at 50 cents, 51 cents, you sold it for 74. And if you bought it, it would have been a small loser in that case. But pretty much it looked like, that it was in line. This is how we're, when we're talking about averages, right? When we're looking at these averages, that doesn't mean that anything's exactly on it. Averages means like, fluctuates around those averages. The average is just, it's taking all the numbers and getting the average. So an average benchmark isn't a exact target price. It's just telling you that's where it fluctuates around the average. But you could see that it was a little bit below. So that's one way to start to take a look at a strategy. We could go back, right? You don't have to forward test. This is we could go back, December 27th, do the same thing. We could go look at special situations. But what the benefit of this is that you could prepare and you don't have to sit there, eyeball a real-time quote, and then try to forward test a theory or a hypothesis. You could go back, you could go back to yesterday's data. You could go back to the previous day before that and start to learn about the different dynamics of how the markets work, test out your theory, take a look at the markets, at a point in time, what would I do at this moment, and plan and map out your strategies that way. Right. So I guess there are no questions. Well,
Yeah, you're right up against the opening bell. It's 9:28. Awesome job, D. As always, remember it's a 3-day weekend. Everyone have a happy new year. Great job, D. Thanks so much.
Everyone, happy new year. Stay safe out there. Have a great trading day. Have a great weekend. Thank you so
Tuesday,
much for all the support this year. Huh?
Yeah, we'll see you on Tuesday.
Yep, we'll see you guys on Tuesday. Happy holidays. Stay safe.
All right, everyone have a